Assalamu alaikum. Welcome to my YouTube channel. Let's start our today's lecture. In this lecture, we are going to discuss the process of accounting activities, types of accounts, accounting cycle, how to prepare journal entries, and we'll solve a daily life example to understand the accounting terms and how to prepare journal entries. Firstly, let's discuss the process of accounting activities. Accounting comprises of four main activities which are recording transactions, classifying transactions, summarizing the report, and preparation of financial statements. What is recording transaction? Recording transaction in accounting refers to systematic process of documenting financial activities and events that occur within a business. Financial activities are the activities regarding finance such as buying a car, selling a good, etc. What are classifying transactions? Classifying transaction is the process of assigning recorded financial activities to specific accounts or categories. In short, classifying transaction means to categorize the transactions that are already recorded. For example, we can categorize the transaction as assets, liabilities, or expenses. Then we have summarizing the report. Summarizing the report, as the name suggests, it summarizes the classified financial information such as the liabilities, what were the assets, or what were the expenses in a summarized or condensed format. What is preparation of financial statements? Firstly, let's see what are financial statements. Financial statements are the statements that are presented to an external party or third party for getting some loan or to show financial position. So let's read. Financial statements are formal records of financial activities and position of a business, presenting a summary of its financial performance and position over a specific period of time. So let's understand these activities with the help of an example. Let's imagine a scenario. You are running a shop and write each activity of sale and purchase on a diary. Writing what you bought or sold is like recording transactions in accounting. Now think that your diary have different sections for different type of activities. Let's consider separate section for sale and separate section for purchase. This refers to classification of transaction in accounting. At the end of the month, you want to know that how much you have earned and how much you have spent in purchasing the stock for shop. So you add up all the amounts in each category. In accounting, it refers to summarizing report to see big picture of your finances. Now let's consider you have to take loan for your shop, so you have to show your financial condition to the external party or stakeholder so that they can give you a loan. So you will create a report of your income, expenditure and savings. In accounting, this refers to preparation of financial statements. In accounting, financial statements include income statement and balance sheet. I hope you understood. Now let's discuss types of accounts a company may hold. There are five main types of accounts that a company may hold. These are asset account, liability account, equity account, expense account, revenue account. Asset accounts keep track of assets that a company can hold. For example, a company can have cash, a building, goods. Then we have liability account. Liability account is used to keep track of liabilities that a company owes to some external party. For example, these can be loans, outstanding payments, etc. Equity account. Equity refers to the ownership interest in a company. So the equity account show the contribution of the owners and the accumulated earnings or losses over time. What is expense account? As the name suggests, it tracks the cost incurred by a company in its normal operating activities. Now what is revenue account? Revenue account record the income generated by a company. Now let's discuss accounting cycle. What is accounting cycle? It is a series of steps or stages that business go through to process financial transactions and prepare financial statements. In short, it is a stepwise procedure to prepare financial statements. Now let's see what key steps it includes. It includes identifying and recording transactions, preparing journal entries, preparing general ledger, adjusting trial balance, preparing worksheet, adjusting entries, preparation of financial statements, and closing the financial book. In this lecture, we will discuss the first two steps. We will discuss the other steps in the next lecture and we'll solve the examples according to them. So now let's move towards our first two steps. Identifying and recording transactions. In this step, we just have to identify and record a transaction that have significant impact on your finance. For example, buying a car have a significant impact on your finance as it depends on different factors like can you afford the car to buy as full or you will have to pay monthly installments. Operational cost of a car such as fuel and maintenance. These factors have a significant impact on your finance. If you afford, then you can buy, otherwise, you cannot. How transactions are recorded? Transactions are recorded in a journal. A journal is the first book of accounting. Preparing journal entries. What are journal entries? Journal entries are the initial entries that occurred on a daily basis, are recorded in the first book called journal. As they are recorded in a journal, so they are named as journal entries. It is a very crucial step because upcoming or other steps depend on the journal entries. Now let's see the format of journal entries. Format of journal entries include four columns that are date, particular, debit, credit. Let's see the format. We have to make four columns. The first column is date, the second one is particular, the third one is debit, and the fourth one is credit. Before creating this kind of table, we have to mention journal entries, mention the month, name, and year for which we are going to record the journal entries. In date, we type month date. In particular, we write name of account to be debited. Then in the next line, with some space, we write name of account to be credited. And after that, we write a narration. For example, the good is being sold or the good is being purchased, etc. Then we write debit amount and credit amount. Amount can be in rupees, in dollar, in any currency. I just have written as an example. Now let's solve this example. So see you in the next part. Thank you.